Welcome to Module 4 lecture, where we combine bond and stock valuation. We build up on the knowledge from last session where we learned how to calculate the present value and future value of a single cash flow and of multiple cash flows. Valuation is an important concept in corporate finance. In Module 1, we saw that the objective through which we evaluate the key financial decisions made by the firm is the maximization of firm value. Accordingly, in this module, we examine how we can value financial assets and securities, including the firm's equity and debt. After this module, you should be able to know about bond features, the relationship between bonds and interest rates, and what is the term structure of interest rates. Also, you will learn how bonds are reported in the market. Same with shares. How to value shares, which is cash flow dependent, and see how shares are quoted in the press. When Qantas reported their first loss back in 2012, since it was privatized, it had a negative effect on the value of its shares. Investors and the market reacted by a major sell-off of which wiped 1.1 billion of its market value. This implied that the shares were not correctly valued. Why did this happen? The value of a share is based on the future dividends that it receives. If losses are reported, it means there are no dividends to be received or lower dividends. Therefore, the present or current value of a share reflects that fact. Estimating these future earnings and in turn dividends makes share valuations a difficult task. This model can mathematically express the price of any asset at time zero, today, where its value is the present value of all its future cash flows. The equation is just the present value of multiple cash flows we learned in our last session. Because we calculate a present value, the interest rate is also known as a discount rate, and this rate reflects the risk of the asset. In the context of valuation, we call this rate the required rate of return, because it's the return required by investors for investing in assets of a given risk. We will talk about this in later modules. For now, we will take this rate as given. What is a bond? A bond is a financial instrument issued by corporations or governments when they want to raise money. In essence, the company is borrowing money from the public. Remember, firms can raise capital in two ways: by issuing equity or shares, or by borrowing from the bank or issuing debt in the form of bonds. Bonds are generally issued over the long term in the form of interest-only loan. The principal or par value or face value is the amount that is borrowed. Because we said bonds are interest-only loans, this principal, usually $100, needs to be paid all in one lump sum at the end of the loan. Maturity date, usually stated in years, is the time when the bond's life ends, and at that date the company must pay that principal. The coupon is a fixed amount of interest paid regularly to investors, which is based on the coupon rate and the principal. In general, for corporate bonds, the coupon is paid every 6 months, while government bonds pay coupons quarterly. But that's not usually the case always. The indenture is a legal document prepared at the time of issuing the bond, which specifies the conditions of the bond, like the coupon rate, when the payment is made, or any other conditions. The coupon rate is the quoted rate upon which interest on a bond is calculated. If the face value or par value is 100 and the coupon rate is, say, 12%, we know that the regular interest payment or coupon payment is $12 per period. The coupon yield, also known as current yield, is calculated as the coupon value divided by the market value of the bond. And the yield to maturity is the rate of return investors earn if they buy a bond at time zero and hold it until maturity. This yield is the interest rate that enables us to calculate how much the bond is worth in the market. For example, if we have a $100 bond that pays 12% coupon and we want to sell it, how much can we get for it? What is its market value? The yield to maturity, or yield for short, allows us to find that market price. This is an example of how bonds used to be issued in the old days. Here we have a bond that has a coupon rate of 5 1/4, repayable or when it matures on November 1987. It has been issued in February 1966 and it has a face value of $20. In November, Treasury would have paid back this $20 to investors back in November 1987. At the bottom we have the coupon payments. In the old days, investors would tear a coupon and present this in exchange for interest payment. We also observe that the bond has semi-annual coupons, as the interest is paid every 6 months. So the value of a bond is the present value of its cash flows, or interest, or coupon payments. Principal is a cash flow too, as it needs to be repaid at the end of maturity. Therefore, the cash flows of a bond are the coupons and the principal. So the value of the bond, or its price, equal the present value of its coupons and the present value of its principal. Now, these coupons are equal interest payments that occur at regular intervals of time for a known period. And remember from last module, that's the definition of an annuity. Therefore, the market value, or the price of a bond, is calculated as the present value of an annuity and the present value of a single sum. Last module, we also mentioned the inverse relationships between present values and interest rates. Because when we calculate the present value, we are discounting, we are bringing back the value from the future. The higher the interest rate, or the discount rate, the lower the present value. Applying this to bond valuation, as the market interest rate rises or the yield to maturity increases, the bond prices will decrease. This is an illustration of the inverse relationship between prices and yields. What we have is a downward sloping line showing that, holding everything constant in terms of coupon and maturity, the higher the yield, the lower the price, or the market value of the bond. Note that here we have a bond with a face value of $1,000, coupon rate of 10%, therefore the coupon is $100, and with a maturity of 20 years. And this is the formula on how to price a bond. It looks familiar, doesn't it? It's just the present value of an annuity plus the present value of a single sum. See how it all flows now from a simple present value formula for a single cash flow, then to multiple cash flows, then multiple cash flows that occur at regular intervals. We call those annuity. And all that to get to this bond pricing formula. Let's look at some examples. On January the 1st, this company had a bond outstanding with a coupon rate of 9.125% and $1,000 face value. The bond matures at the end of 2022. The market currently requires 8% returns on these bonds. what is the current market price or the value of this bond? So always state the variable. Write down the variable so to avoid confusion. Remember, the coupon is found by applying the coupon rate to the principal. So based on those values, the coupon payment is 91.25. The required rate of return or the yield to maturity is 8%. And the bond has 11 years to maturity. Why 11? Because we value the bond at the beginning of 2012. Applying the formula, we calculate the bond current value, which is $1,080.31. When solving this sort of equation, please be aware of the order of operations. If using a calculator, this is how you should enter the variables. Make sure that you close all the brackets. And this is the timeline showing the coupon payments, and in the last year the principal gets repaid as well. If using Excel, the present value function is used to value the bond. Again, make sure that the payment and principal are entered with a negative sign. Now, I want you to find the value of the same bond, but instead of 8% yield or interest rate, the bond's yield is 10%. You should stop the recording and attempt this calculation. You should get a value that is less than $1,000. In fact, the bond price is $943.16. So we observed that before, when the yield was 8%, the bond value was greater than the par value. It was 1,080, which was greater than 1,000. But now, when the yield was 10%, the bond value was less than the par value. 943 was less than 1,000. Everything else was the same, only the yield changed. Relative to the coupon rate of 9.125%, in the first example the yield was less than the coupon at 8%. In the second example, the yield was higher than the coupon at 10%. Keeping this in mind, we can now state the relationship between bond prices, coupon rates, and yields. If the yield or interest rate is greater than the coupon rate, the price is less than the par value, and we call that a discount bond, or the bond is selling in the market at a discount. If the yield is lower than the coupon rate, the price or the market value of the bond is higher than the principal. And that's a premium bond because it sells for more than the par value. If the yield is equal to the coupon rate, the price is equal to the par value, and we say that the bond sells at par. The market value of the bond is just equal to the original issue price. The coupon, term to maturity, and the par value are fixed when the bonds are issued. So the only thing that varies due to economic forces is the market interest rate or the yield. Hence, because the yield varies, the price varies. Now I want you to solve these two problems. I want you to find the values of these bonds, keeping in mind that both have the same coupon, same principal, and the same maturity. The only difference between these two examples is the yield to maturity. Knowing the relationships between coupon yields and prices, you should get an idea of what answer you need to get. So therefore, in the first example, you should have a discount bond, and in the second example, you should have a premium bond. So the first answer is $92.03, and the second answer is $119.63. This is a different example where the interest is paid semi-annually. A $100 bond has a coupon rate of 14% with semi-annual coupons. The yield to maturity is quoted at 16% and maturity of 6 years. Now, even before we do the calculation, we should know that this bond sells at discount. Why is that? Because the yield is higher than the coupon rate. 16% is greater than 14%. So immediately you think that when doing the calculation, the result should be less than 100, the face value. We mentioned that corporate bonds are issued with semi-annual coupons, meaning that the interest is paid twice a year. To account for this, when we perform the calculation, we transform everything into semi-annual variables. Therefore, note that we have 12 coupon payments. Because we have 6 years, multiplied by 2, we have 12 periods. So we have 12 coupon payments. And because the coupon rate is paid twice a year, the interest payment is $7. $7 is the semi-annual payment. 14% divided by 2 is 7%. 7% applied to 100 is $7. What is the semi-annual yield? It's 8%. 16% divided by 2 is 8%. The important thing is to convert everything, coupon rate, payments, number of periods, and yield into the same time unit, the same as with annuities.